There's $800 billion of Australian retirement savings sitting in the middle of the biggest speculative bubble in history. Most Australians don't know it's there. This is the story of how a bubble in America becomes a crisis in your superannuation account, and why the people who should be warning you aren't. Before we go any further, this is not financial advice. Talk to a licensed advisor before making any decisions. I'm here to help you ask better questions. Let's start with the bubble itself. OpenAI is worth $730 billion. It has never made a profit. Anthropic, the company that built the AI I used to make this video, is worth $380 billion, also not profitable. Microsoft, Google, Amazon, and Meta are spending $660 to $690 billion combined on AI infrastructure this year alone, the largest corporate investment cycle in the history of capitalism. And NASDAQ concentration, how much of the entire market is controlled by a handful of tech stocks, has now exceeded dot-com bubble levels. The bulls will tell you this is different. The big AI companies have real revenues, real cash flow, and they're right, partly. Here's the part they leave out. To justify today's valuations, AI companies need to generate $2 trillion in revenue by 2030. That's 3 to 4 times what they earn now. And most of what they're spending it on each other. Circular. The hyperscalers are billing each other and calling it growth. We've already seen what happens when the narrative cracks. A Chinese company called DeepSeek released an AI model that performed like GPT-4 at a fraction of the cost. Nvidia lost $589 billion in market cap in one day. That was a tremor. This is about the earthquake. Here's what most people aren't talking about. There's a new mechanism that could make this bubble bigger than anything we've seen before. It's called tokenization. Tokenization turns real-world assets, including shares in private AI companies, into digital tokens, buyable by anyone on Earth. No broker, no minimum investment, no accredited investor requirement. This market quadrupled to $18.2 billion in 2025. Analysts forecast 30% of the entire global financial system will be tokenized by 2030. Think about what that means. For the first time in history, a farmer in Indonesia or a student in Brazil can buy a piece of OpenAI. No experience needed, and when the story is this compelling, they will. Now add one more ingredient. Richard Werner predicted the 2008 financial crisis. He coined the term quantitative easing. He has one of the most accurate macro track records alive, and he's been warning about something called CBDCs. Werner's argument: central banks engineer a banking crisis. The public panics and moves money into CBDC accounts, digital wallets held directly at the central bank. Commercial banks lose their deposits. They shut down. The central bank becomes the only monetary authority left. And unlike cash, CBDC is programmable. The central bank decides what you can spend it on. Werner's words, not mine. It's not really money, it's potential money. You have to apply. May I please use it to buy this? This isn't speculation. 146 countries are exploring CBDCs right now. 98% of global GDP, China's digital yuan, has processed 16.7 trillion yuan in transactions. The RBA has already run its own proof of concept. So here's the sequence. CBDCs lower friction. Tokenization opens AI stocks to every retail investor on the planet. The last wave of money floods in. The narrative becomes so powerful that skepticism feels foolish. The bubble reaches a level that no revenue can justify, and then, one moment, it breaks. Here's where Australia comes in. The superannuation system holds $4.3 trillion. 20% of that, $800 to $860 billion, is in US equities. The biggest holdings are Microsoft, Apple, Amazon, Meta, and Nvidia. Australian super alone held around $2 billion in Nvidia, your retirement savings, sitting in the eye of the storm. And in 2026, the Albanese government signed a deal that could channel over $1 trillion more Australian super dollars into US infrastructure and tech. Critics call it a one-way ticket into America's next speculative boom. The government calls it a partnership. Run the numbers. A mild correction, AI stocks fall 15%, Australian super loses $130 to $150 billion. A genuine bubble burst, 65% drawdown, 450 to $550 billion gone. A full GFC scale event, 600 to $700 billion from your retirement savings. But here's the part that makes it uniquely brutal for Australians. The Australian dollar is a risk on currency. When the world panics, the AUD falls hard. Every time, GFC, COVID, Liberation Day, every time. So when US stocks fall 30% and the AUD drops from 64 cents to 52 cents at the same time, your super hasn't lost 30%. It's lost closer to 45% in Australian dollar terms. You get hit twice, once on the asset, once on the currency. And the Reserve Bank, our last line of defense, is already trapped before any of this happens. Inflation is running at 3.3%. The RBA's own target is 2 to 3. GDP growth is 1.3%, what the RBA itself called anemic. You hike for inflation, you cut for recession. You cannot do both. The RBA is caught between two emergencies simultaneously. Werner goes further. He says the entire relationship between interest rates and economic growth is backwards. Not low rates cause growth, growth causes rates. The evidence for the standard story? He says there are 0 peer-reviewed empirical studies showing it works. Not one. So here's the worst case laid out simply. Bubble bursts, global panic. AUD falls to 50 cents. Petrol, electronics, food, everything priced in US dollars gets 20 to 30% more expensive overnight. Imported inflation. The RBA cannot cut rates. The economy contracts. High rates and recession at the same time, that's stagflation. Werner also believes the US Treasury will respond with what he calls Treasury QE, directly printing money and injecting it into the real economy, not into bank reserves, into the economy. When that happens, the US dollar loses value, commodities and hard assets surge, and bonds, already hammered in 2022 and 2023, get a second leg down. None of this stays offshore, it comes home. Australian consumer confidence is already near record lows. Credit card balances just hit a 4-year high, $44.6 billion. Australians are borrowing to pay for essentials. The stress is already there, before the shock arrives. There's a concept called the 18-year property cycle. It's been remarkably consistent. The last Australian peak was around 2007. The next one, by that model, is right now. 2025 to 2026. Post-peak corrections run 1 to 4 years. Werner's framework makes this alarming in a specific way. Banks have been lending primarily for property and asset purchases, not productive investment. Bank equity is only around 10% of their balance sheets. If property prices fall 20% from peak, the entire equity buffer is gone. The banking system is technically insolvent. That's not Werner being dramatic, that's arithmetic. And the government just removed negative gearing for established residential properties purchased after May 12th this year. Effective July 2027, a policy headwind landing exactly at the cyclical peak. The timing is not ideal. None of this is destiny. Bulls exist for a reason. AI companies have real revenues, Australia is resilient, central banks are resourceful. Bubbles are notoriously hard to time. Smart people have been calling this one early for 3 years. But Werner's signal is clear. Don't watch interest rates. Watch credit growth. Watch whether banks are still expanding lending for property and financial assets. The moment that plateaus, that's when the Ponzi math begins. That's the real indicator. One thing you can do right now, today, find out what's actually in your super. Most Australians genuinely don't know. Log in. Look at the international equities allocation. You have options: conservative, balanced, growth. They are different things. A licensed financial advisor can explain what's right for your situation. This video is not financial advice. It's a set of questions worth asking. The decisions are yours. If this connected some dots for you, subscribe.